How's it going, guys? My name is Ishan, and in this video we're going to be talking about whether FUBO stock is really the next Netflix. We're going to be covering all the good and the bad and why I actually believe the company could be acquired. Along with that, a quick technical analysis to identify the best places to buy. So if you appreciate these short and value-packed videos, make sure to drop a quick sub and let's clock in.
Turn it up a little bit more.
So FUBO stock has been getting absolutely destroyed. We ran up all the way to the high of 60 and are now in the mid 20s, all thanks to Rich Greenfield's short, and after millions of shares have flooded the market. Google and many platforms are showing the market cap to be 1.5 billion, but with Bloomberg we can see the real market cap is actually 3.6 billion, meaning Rich is pretty right. So at its peak the company was worth almost $7 billion. Now let's actually get into Fubo's core business. So to put it simply, they're like a sports streaming company. They do live broadcasting of sports and many other various channels including MLB and ESPN and many more. Its main competitor is actually YouTube TV, which has over 3 million subscribers, but unlike them, FuboTV is actually seeing impressive growth. Subscribers grew 58% last quarter, close to 500,000, and FuboTV has guided 435 million in revenues for next year, meaning the stock presently trades at 7 times forward sales. That's absolutely massive revenue growth and shows the company is severely undervalued. Like, it's not very often you see a company putting up these kind of revenue numbers and growth only trading at 7 times forward sales. But here's the but. I did say I'll give you guys all the good and the bad. You know, everyone loves to hear the good, but as a smart investor you have to be able to look at stocks objectively. And the thing about FuboTV that stands out particularly is their operating costs are not that good. They had to pay out 61 million in subscriber expenses and 10 million in broadcasting fees. They're losing a lot of money because rights to streaming aren't cheap. Unlike, let's say, Netflix, who produces all these shows and TVs, with streaming you actually have to pay these companies for the rights to stream, and those can get quite costly, and so they've been losing a ton of money because rights to streaming aren't cheap. In fact, their SEC filing even says that the cost of affiliate distribution rights is generally incurred on a per subscriber basis and are recognized when the related programming is distributed to subscribers. So what this means is that more subs equal higher costs. As FuboTV begins to acquire more subscribers, that just means they're going to have to pay higher licensing and streaming costs. They have liabilities of 247 million and only 58 million in assets that can be turned to cash right now, plus their 197 million in IPO money, and that's just barely enough to cover all that debt, and so probably another capital raise will be needed, meaning more dilution. As we saw with Roku negotiating with Peacock, that process took years, so I'm still iffy on the whole argument that they'll be able to negotiate rates lower, but I still think that they can mitigate some of that damage by increasing ad revenue and also starting their gambling service, which brings me to my next point. So they bought Balto Sports, which provides software which FuboTV plans to use to implement gambling into their business. FuboTV is sports first, and that's why people come to FuboTV, and so I believe this is a massive and huge opportunity because of that. And they have the advantage compared to DraftKings and Barstool Bets, because if you're watching sports on the same streaming service which also allows you to gamble, it just makes sense to gamble and watch on that very service. And so it's a huge opportunity, and I think this actually offers them the chance to mitigate some of those weak margins and lead to profitability. And the whole point the CEO was even saying is the focus right now is to get as many users as possible, and so I assume that gambling will eventually become the driver of profitability for this company. And as we can see, the sports gambling industry is expected to grow to 8 billion by 2025, up from $1 billion in 2020. So this is a huge opportunity, simple as that. However, they're gonna need a ton of money to do so. Again, my goal isn't to bash FuboTV, but just to present the facts as they are. As I mentioned, they have huge debt. Their core business is a money burner, and setting up gambling software, let alone then spending millions on marketing and getting people to switch from DraftKings and FanDuel, will be very hard and costly. And so this again brings me to the point that they'll most likely have to raise cash again, and so as many shares have already been added to the float, I think more pressure could be even worse going forward, and it's going to be pretty hard to pull off. And it's for these reasons I actually believe that FuBo could be acquired. They really need the money. Not many people know this, but they already merged once with a company called FaceBank to stay afloat, and that company actually took $100 million loan on their behalf, so this is a very costly business, as you can see. The only reason YouTube TV can take the hit is because they're generating a lot of money from other avenues. FuBo can't keep raising prices because at what point do they just become the same as cable with less options? They already cost $65 with the average cable bill just at over $100, so they're inching there, and then convincing people to switch when you have limited offerings and are just as expensive is impossible. And so I really think they'll be bought out or sell the business. To who, I don't really know. This definitely isn't Netflix, who people ought to look at and say, well, Netflix ought to lost a lot of money when they were getting started. The difference is Netflix's service is a lot cheaper and easier to bring people on. They have an array of content compared to limited content FuBo has, and it's not even their own content. FuBo is licensing that, and then Netflix also has higher margins. And so eventually I think someone like Disney or maybe even YouTube TV take on their business. I don't see FuBo as being a great long-term investment, but for the next year in the short term, I am definitely going to be trading this. And this leads me to the technical analysis to identify where the best opportunities are to buy. So the stock found support at the $22 level, but formed a dragonfly doji on the daily chart as well, showing that despite the temporary push, bears were able to take control and push the stock back down. So it's a pretty bearish move, and below $22 we could definitely see the stock go down all the way to 15. But if we can hold at $22 level, I could see the stock easily filling the gap at $32 and then potentially even running back up to $40. So those are the key levels to watch. It's key to see, can it hold that $22 level? If it can, we're probably heading higher. If it breaks below, well, we got a massive floor to fall through. But overall, I think the stock is pretty oversold, so I'll personally be looking for a short-term long play. So guys, that's the video. Make sure you like, subscribe, and check out genztraders.com if you want to support the channel and learn something new like technical analysis. And be sure to let me know down below what you guys think about FuBo stock. Are you buying? Do you not want to buy? Are you going short? Whatever, it doesn't matter. Do all that good stuff, and I'll see you guys next time. Take it easy. Clocking out for now. Peace.